Now, the White House today said that a deal about raising the debt limit and cutting the budget is still possible. President Obama is expected to meet with Senate Minority Leader, the Republican Mitch McConnell, in just a few moments from now. Earlier, the president held talks with Senate Majority Leader Harry Reid. Now, the country could exceed its $14.3 trillion debt limit on August the 2nd, mark your calendar, if no agreement is reached by then. So we'll look at the debt problem with my next guests, Chris Rupkey, the chief economist at Bank of Tokyo-Mitsubishi. We also have Axel Merk. He is the president, founder, and chief investment officer at Merk Investments. Gentlemen, good to have you with us. Chris Rupkey, you've written that these late deliberations, these ongoing back and forth between the White House, between Democrats, Republicans, are making you nervous. Why?
Well, this is, they're trying to get the fix right fundamentally and fix it for all time. But when you come down to the brink here and do it at the last minute, you could really screw it up. You could, make new laws that, potentially won't cure the deficit. I mean, don't forget, wasn't there a Social Security Commission that fixed Social Security? There's at least one every decade that does that, and it's still in trouble. So, yeah, I'm a little bit worried. I'm a little bit worried about the brinksmanship, frankly, that we're getting this close to actually maybe defaulting.
So worried that the brinksmanship could carry us over the brink. Axel Merk, do you think that that's likely?
Well, right now, the market is pricing in that this is mostly a game of chicken, and we have brinksmanship all the time in the U.S. and in any other country, for that matter. But what I'm concerned about, as you well know, I tend to take the international perspective on things. If you look at the yields in the treasuries, they suggest that there's almost a panic out there that there might not be enough treasury bills available. 3-month bill yielding about 2 basis points on an annualized basis right now. And what that means is that the liquidity isn't there what it used to be. And what it means for foreigners, the Chinese, that they deploy large amounts of money in the U.S. Obviously, they may not choose treasuries necessarily, but longer-dated bonds. But if the liquidity advantage is no longer there, why invest in the U.S.? One of the key reasons why they have been very slow to diversify out of the U.S. dollar is because of liquidity. Now, if that is gone because of the bickering, well, they gain operational experience in other countries, and that will cause long-term lasting damage beyond the game of chicken playing out right now.
Chris Rupkey, do you agree?
Well, part of me has some sympathy for the idea that you can get very, very close to the brink, because where is this money going to go? There's $9 trillion in U.S. marketable debt, half of it around the world, half of it in the U.S. Where's $9 trillion going to go? Nowhere. There's no other market in the world that can go to.
Chris Rupkey's pocket.
People say it could trickle out, but I think most of these investors are captive, and as your guest said, there's strong demand for treasuries right now, just in case they stop issuing treasuries.
All right. Chris Rupkey, this idea that we can grow our way out of our debt, is that just completely inaccurate?
Well, the Fed chairman has told Congress before, no, we can't do that. But I would argue, as GDP grows on year after year, 4%, that will shrink the deficit, the debt level relative to GDP. So, we can grow our way out of it, but when you're starting at $1 trillion deficit, it's not so great. I would say that we want to focus on marketable debt, which is a lower percentage to GDP than if you count all the Social Security type of non-government security debt. That would put our debt to GDP somewhere around 70%. It's not quite at 100% yet, so I think we can calm down a little bit.
We can calm down a little. Well, Axel Merk, what about this idea that maybe we ought to just calm down a little bit? Maybe if we can get Democrats and Republicans to calm down, they can come up with some kind of fix that would satisfy both sides, raise the debt ceiling, and then we could move on to meaningful reductions and also possibly have a conversation about tax increases.
That's great, but then people will watch The Wizard of Oz and not Bloomberg anymore. No, this is the Democrats and Republicans coming together. It's not going to happen. What we have to wait for, unfortunately, is the bond market. In Europe, we see that the bond market is the one incentive policymakers are listening to. Think about what amazing steps have been taken: Portugal, Spain, Greece, because of the encouragement of the bond market. In the U.S., because we printed so much money, that incentive is not there. So we need to wait probably until the bond market derails for policymakers to get their act together. It will happen that they get their act together, but that may need to happen. And unfortunately, because of our current account deficit, we are far more vulnerable to a misbehaving bond market than the Europeans are.
Chris Rupkey, we're definitely not in Kansas anymore, at least according to Axel Merk. Is it possible, though, that governments are going to push the economy into greater problems because of their austerity measures? You heard Axel Merk talking about what they've done in Europe, but how could you possibly do that in the United States and then still expect the economy to grow?
Yeah, they could. I mean, if they were to make the cuts too, draconian, but I haven't heard many cuts that they're talking about right now. I think one of the issues for the U.S., unlike Europe, is that we're trying to attack right now the long-term deficit problem, which is associated with the baby boomers' health care needs and their Social Security retirement. And that's something that's going to play out over the next 15 years and not get really bad for another 10 years now. So, what Congress is trying to do today, the Republicans, is trying to fix that now, and that's a very long-term problem. The first baby boomer just turned 65 this year, as you know. It's a long ways away before they start drawing down and need government spending programs at the level they're eventually going to need. Now, it's very scary what's happening 10, 15 years from now, but are we supposed
does that mean that we're going to make
today?
Right. In other words, is that going to mean that we make decisions today that are not necessarily smart decisions because of this pressure, or maybe it's created pressure, or indeed some people feel it's real, that we've got to solve these big problems right now? Yeah,
there's an urgency that probably does not need to be there, and it's perhaps fed by what's going on in Europe, the sovereign debt crisis. I hope they don't make any mistakes, like certainly with Medicare.
Axel Merk, so given what Chris Rupkey says, and your opinion right now, what are investors supposed to make of the situation? Should they be squaring their positions? You said earlier that many investors maybe are looking to alternatives than U.S. Treasuries.
Well, yes, but where do you go? U.S. money market funds have over half their position in commercial paper issued by European banks. There is no such thing anymore as safe assets. Central banks are diversifying their cash holdings to other currencies, so that's something investors may want to look at. And ultimately, I agree that most likely it's a game of chicken. The question, though, always is, what is the risk that it's different? One of the things is that the rating agencies won't be late in downgrading anybody this time around. So there is an unknown. And I agree that we have a few years left, but we just don't know how long. It's like saying that, I'm going to get out of tech stocks when the bubble bursts, or I'm going to sell housing once housing comes down. It's very difficult when that moment comes. And the more prudent approach is, of course, to take the right steps ahead of time to diversify for those sort of risks. And unfortunately, in the absence of a compromise on both sides of the political aisle, inflation is the path of least resistance. You nominally pay what you promise to retirees, but at the same time, the real value of those isn't worth quite as much anymore.
Chris Rupkey, what about this notion that inflation is the path of least resistance? There's even a conversation about recalculating the way that the consumer price index is reported.
I don't think that's going to save enough money over the long term. The reason why they're attacking these entitlement programs, baby boomers, Social Security, and Medicare, is that 55% of our outlays are mandatory. So you really
have no
can't
control over unless you actually.
Yeah, so you have to start dipping into these programs, but these programs are very complex. I think they're going to defy a quick fix. I just hope this doesn't go down to the wire again. I'm going to be on vacation on August 2. Don't forget when they shut down the government, tried to, April 8. When did they announce, a
deal?
A deal? It was at 10:30 at night. Before midnight.
I can see someone's ruined vacation right now.
I think we should be here right now at August 2 at midnight.
Axel Merk, you think it's going to go down to the wire, August 2, midnight?
Well, sure, why not? That's what policymakers are good at. Unfortunately, that's not all that helpful. But yes, the bickering will continue, and then maybe we have a compromise earlier. Unfortunately, if they increase the debt ceiling, it's going to be just enough to have the same debate again next year, just ahead of the election. We're not going to have real solutions because neither side of the aisle is really addressing the structural reforms sufficiently. So we'll just have plenty to talk about. There's not any real change expected, and we'll revisit this next year.
I want to thank you, gentlemen, very much. Axel Merk, Merk Investments, Chris Rupkey, Bank of Tokyo-Mitsubishi.